you could have made a little under $126,000 if only you invested $1,000 with Tesla back in 2012.
Hey guys, we're Therapeutic Finance and we're back with another video. I'm Naja.
I'm Broderick.
And if you're just tuning in, we're all about rehabbing our finances and hoping to inspire you to rehab yours.
Today, the topic is stock market. All right, our goal is to build generational wealth. And I think in order to get there, we need to start doing what wealthy people are doing. And what wealthy people are doing is they're finding ways for their money to make money.
We're here to share it with you. It's something that we didn't grow up around. We, had to kind of figure out on our own, and we're out there, and it's not something that's taught in school. We're just trying to get out here. We're just trying to show you different ways that we're doing things and giving you some ideas.
We have to find ways to make our money work for us. Let me let you in on a little secret. You're not going to be able to work your way to financial freedom, and you're not going to be able to save your way to financial freedom. The reasons why we can't do that is because of this little thing called inflation. Every year, your money is losing value. And if your money is not growing, you're going backwards. You're not going to get a 6% raise. That's what inflation is this year. You're not going to get a 6% raise every year. You're not going to get 6% return on your savings account. You're not. So we have to find places to put our money that's going to grow faster than it's depreciating, because every year the value of your money is going down. So we have to find ways for it to grow faster.
Yes, and one of those ways is investing. So what investing is you're putting your money aside and you're having your money make money, and over time you're getting a return.
So when we talk about investing, do know that there are many different ways and avenues that we can go about investing. We can invest in the stock market, which is what we're going to talk about today. We can invest in real estate. We can invest in businesses. You can invest in someone else. I mean, this is my greatest asset right here beside me. So
let's start off with the basics. What is a stock?
So I think the first thing we need to talk about is the companies, because that's what it is. First off, we got private companies and we have public companies. With private companies, you have one owner, two owners, a group of people, whatever, that's their own thing. But we have public companies as well. With public companies, there's not just one owner. There is the big guy, the CEO, or whoever it is that we all talk about, Elon Musk, who has a 15-20% share of the company. But the rest of that big pie, we as the people, we can buy into it. We can get a piece of that pie. We can get a piece of that growth.
So with the stock market, you can invest in different things. You can invest in a single stock, mutual funds, ETFs, and we're also going to talk about REITs.
A single stock is where you invest in one separate company. That's Facebook, Apple, Tesla, whatever it is, you buy one piece of that single company by itself.
So single stocks are cool and whatnot, but they're also riskier because, you're putting your money into this one company. Okay? Kind of have to really do your research and know what it is you're investing in. Of course, some companies like, our bigger companies like Google, Facebook, these are companies we know are not going anywhere, basically.
And with single stocks, I agree. I've personally seen stocks go up, 100, 200% in a short period of time. Tesla. And
I was like confused right then. I'm like, are you okay?
And I've seen stocks go down 70, 80% in a short period of time. Zoom. But like she said, they are risky. The next thing that you can invest in are mutual funds. And that kind of takes the risk out of some of it. Because with mutual funds, what you're doing is you're buying into a fund and there is a fund manager, which is just someone that takes your money and invests it for you. You don't actually see the person, you just buy into the fund. And whatever that fund is supposed to do, different funds invest in different things, and it's supposed to be written out exactly what they invest in. So it may say that, you know, our fund mimics the S&P 500, or it may say that our fund invests in large cap growth stocks and whatever else. Each one is going to say what its purpose is and what it is it does.
That's where me and Broderick kind of differ. I love a mutual fund. Like, I'm always looking at mutual funds because you're in different companies. It's safer. So there's funds who you may have a percentage of holdings in Google, Microsoft, like just all these big companies. Versus a single stock, which Broderick prefers single stock. If you know us personally, it just kind of makes sense that I'm a little safer and he's a little riskier. So,
and the thing with mutual funds, like she said, they can be safer just because you have a professional managing it, and it's diversified for the most point. Different funds are going to invest in, whatever it is they want to, but a lot of times they're in, 10, 15, 20 different companies. So, if one company's doing bad, then hopefully another company's doing good, and vice versa, to try to kind of even things out. So the ride isn't 280, it's more like 5, 10, 5.
Also, too, you can expect it not to grow as fast. They say, what is the saying? With great risk, there's reward. I don't know. Is that how it says?
Great risk comes great reward.
Yeah.
I guess. At no point am I saying that a mutual fund can't be very lucrative, because there are mutual funds that go up 100 and 200%. So it does happen. The next thing we needed to talk about is exchange traded funds. These are ETFs. ETFs are usually mutual funds, exactly what we just talked about, where there's a fund manager buying and selling stocks the way that they think, is best for the fund to grow. These ETFs, they're kind of treated like single stocks, where you can buy them and sell them as they go up, just kind of like you would do any other regular stock. So they're mutual funds that you can kind of get into and out of if you plan on buying at one point, letting it grow and selling and whatnot. And another thing you can get into is real estate investment trust. So if you don't want to get hands-on with the day-to-day of real estate, you can just like you would buy a single stock, invest into a real estate investment trust. These are companies or groups of people that go out, they buy, sell, develop, all things real estate to make a profit, and you get paid from it.
So now you're probably wondering how much it costs to get started in investing into stocks. And the answer is, it can cost as little as pennies, couple dollars, up to thousands of dollars, just depending on what you're looking for, what you're looking to invest into. Now, to start the account, like to open a brokerage account, is completely free. We personally are with TD Ameritrade, but there's tons of other ones out there like Fidelity, Robinhood, Vanguard, lots of different ones out there that you can look into. And they have apps you can keep on your phone and really just kind of keep up with your accounts. But yeah, it can cost very little and it can cost a whole lot.
And one of our favorite things to get into was actually what we started with, are index funds. And index funds are very important because I think that they can be one of the best ways to go about investing. In order to understand index funds, first you need to understand the mutual fund. That's what we talked about earlier. Now we need to understand what an index is, or indices. So you have 3 major indices out there now. So when you hear about the S&P 500, what you're hearing about is the top 500 companies in the United States. And we use that as kind of a barometer to see how did the stock market do as a whole. It doesn't mean that one single stock went up or down, but overall, how everything did, it was mostly down or mostly up in comparison to what the S&P 500 did. The Dow Jones Industrial is another one that you probably hear about all the time. It's actually the oldest index that we use, and it has, I think, about 30 stocks or something in it that they kind of change out from time to time. And it's something we also use to kind of point to what the market as a whole is doing. The other one is the NASDAQ. The NASDAQ kind of favors tech stocks, and it kind of keeps up with how tech companies are doing in reference to the overall stock market. So if the NASDAQ is up, then most of the tech companies are doing good. NASDAQ is down, most of the tech companies are not doing as well. And also you can kind of look at these things in reference to the whole market. Usually we look at the S&P in reference to the whole market, but all three you can do the same. So now that you understand indices and you understand mutual funds, well, index funds is where they kind of meet. An index fund is a mutual fund that follows one of the three indices. So VTI is one that we look at, which it's actually a little different. VTI follows the entire stock market, but you have QQQ, which follows the NASDAQ. You have SPY, which follows the S&P 500. And I don't know what follows the Dow Jones, but you have different stocks out there, mutual funds or ETFs. The ETF is kind of just like a mutual fund that you can buy and sell. But it follows the Dow Jones. So the funds that I named, they're just, one of very, very, very many. I mean, they're countless. So you just go about looking for one, searching, Googling, doing your research to find, which ones that you would like to invest in. The thing to talk about now is the different personality types of investors. You have the risky investor, you have the more conservative investor, you have long-term investors, you have short-term investors, you have very passive investors, and you have hands-on investors. Passive, hands-on. With our personality types, I like to invest more in single stocks. She likes to invest more in index funds or exchange traded funds. So knowing the different personality types, kind of how do they differ? Well, you have risky. Those are people that's gonna invest more in single stocks, maybe even some crypto. You have the conservative, who's gonna invest in mutual funds or ETFs, things that are a little more diversified, where she feels like things won't drop as fast. Then you have short-term investors. With short-term investors, these people, they can be day traders, they can be swing traders, or just people that, find an opportunity and kind of take advantage of it. A day trader is somebody that's buying and selling stocks on a daily basis. You have swing traders who will buy a stock today at $10 and they'll wait 3 weeks for it to hit $12 and then sell it. These are both short-term. Then you have long-term investors, where these people, they'll buy a stock January 2021 and they won't sell that stock until January 2072. So one of the biggest things to understand about the stock market is it moves day to day, and it goes up, it goes down. History has shown that for the most part, the stock market has went up over the long haul. The S&P 500 is what we usually look at to kind of gauge how the stock market is moving. And the stock market usually goes up like 8 to 10% on average per year for the last 40 years or longer or whatever. So I did a little math. Say you're 25 years old and you invested your car payment, which the average car payment is $500 a month. If you contributed $500 a month for 6 years and got an 8% return, then never touch that money again until you turn 60 years old, you would end up with $372,000. and all you've put in was your car payment, $500 a month for 72 months. That's a very, very expensive car that you just bought for $372,000. What if you said, I want to keep this $500 a month up for the next 35 years. You're 25, you invest that $500 a month for 35 years. The amount of money that you'll have at an 8% return every year would be $1.3 million. That is a lot of money. I wanted to point to a few different companies, and I know these are successful companies in hindsight that we're speaking about, but if you can find good companies, stick with them, then over the long haul, you'll come out on top. Just for example, if you bought $1,000 worth of Apple in February 2012, it was worth $17.93. As of today, the making of this video, Apple is worth $167.30. You could have made just above $8,000 in that 10-year span if you just bought $1,000 worth of Apple back this month, 2012. Microsoft 2012 February was worth $30.50. Today it's worth $287.93. You could have made, again, just over $8,000. Tesla, February 2012, was worth $6.75. Today it's worth $856.98. You could have made a little under $126,000 if only you invested $1,000 with Tesla back in 2012. I think it's worth it.
Yeah, really and this is all passive. It's all passive, and your money is just out there making money.
And I know it was a bumpy road for each of those investments. I'm sure plenty of them went down a lot, but over the long haul, look at where they are. So we're all about being long-term.
That's where we're really putting a lot of our money. We're not just thinking about today. We got to think about tomorrow and our future. We want to leave a legacy behind for whoever it is that follows us. We personally are thinking long-term. We're long-term investors. We set aside money each month. We have a savings rate. And when we say savings rate, we mean money that we invest. So
pretty much all of that's going to be invested besides the emergency fund. So.
Exactly. So thanks for tuning in. This is Therapeutic Finance. If you like what you see, subscribe for more content. Yeah, tell a friend to watch this video. And we'll be back next week, next Friday. Peace.